Hey everyone, it's Nick. We're just going over the Trend Trader review for issue 12B that came out mid-December. Um, and remember, we go over uh, the trader trend every couple weeks and just kind of see how we did and go over execution, and I'll answer the questions that I got in emails or on Twitter or under the YouTube page. And also kind of see how things were going and just kind of keep hammering in how to actually execute the playbook. So without further ado, let's work forward in this thing. So this was the final issue of the 912 Financial Group playbook. And as you can see here, kind of going through this, we had the market expectations for December or for mid-December. And listen again, you guys, results will vary depending on how you choose to execute these things. I personally, like I was saying before, I follow kind of what the playbook says, and I execute an investor trend or trader trend based on that. But if you do go back and you test these things, you'll see that they are good risk management even if you pick the wrong one. There's definitely you could 100% do both of them too. So it's really just depends on how you want to do it, your position sizing, your risk tolerance, and so forth. Okay, so going through the highlights on the expectations, uh, kind of repeating some of the same stuff we had before, but we still feel good about that might have been the downside call, at least for the rest of 2022. We just don't think there's enough news or enough days to take it below October levels. Um, Add to that, as we enter the end of the year or down year, there is a high level of expectation of S&P buying via end of year rebalancing, though our call of closing over 4,000 is not going to hit. That being said, things don't look good going forward as central banks suddenly express their impatience with inflation, though prices are easing. It's not the pace they would like, even their targets are around 2% in an environment where it stands closer to 7. And that's where the market is reacting to. They're willing to place economies in a recession to attain their goals, and you see it in the bond market. The US bond market knows rates are still heading higher. You're not retracing in great degree because they're looking beyond the short term, focusing on the recession ahead. The Fed likes um, to kill, grow, and then resurrect it. To kill growth, then resurrect it. China isn't suffering the same fate as the West, is lifting COVID restrictions and vows to support their economy, has fueled capital repatriation. The only recent positive has been the EU oil price cap, which will help with accelerating the drop in inflation. Regardless of fuels Putin's ability to kill Ukrainians, Putin has no problem selling oil at $60 versus not selling it at all. The question is how long the reduced price will take to make it through the rest of the economies to reach a state of deflation that satisfies central banks. All that said, again, means going for the investor trend suggestion, where the suggestion is neutral. The strikes, so the short puts are far enough out of the money to give you either great accumulation levels or money in your pocket, and continue grabbing the featured investor suggestions for the same reason, the great accumulation level or runs to the target for no cost. Minimal worries about getting chewed up on stops like we did in the trader trend suggestions that we advise not to take. As for commodities, metals finally caught a bid, um, but recent tops are probably going to hold. Playing the range is the play. We'd still stick with our quote, given our choice between owning equities at these levels or bonds, we choose bonds. Bonds are an investor's dream. Collect the put premium, walk away. Oil, without the only thing that kills it, is a global recession. Given that's the central bank's goal, we have to embrace the possibility of a sub $60 oil. Bottom line, and with a stress, play it wide. So here we go for the featured trade suggestion. We had Intel on here, and it was basically just a sell to open the December 25th naked put with a stop at 24.59. Now we see that in here, and so we sold the December 25 with the January expiration, and it went through, and we it worked out. So guess what? We had $44. Sold it for 44 cents here. Um, Nothing ever happened, and so we got our 44-cent premium. And so going there, the next one going down to HYG. On HYG, we had the uh, to sell the. Remember, we're doing trader trend here. So remember, you guys, again, there's aggressive trades and conservative trades. Now we track the aggressive trades here. Now the super aggressive is going to be where you actually do the vertical, like down in TLT. So we'll get there. But the whole crux of this thing is on Monday, after you get it, you just put on and you sell the short unit. Again, it's just the selling the short unit is just like being short 100 shares of stock. or long 100 shares of stock if you sold the short put. So, the trader trend here was to sell the 75 naked call, which would be, just like being short 100 shares of HYG with a stop at 74.80. If we go over here, right, you had 71 cents of premium for that. Stock price was 74.31 when it opened, and we did get stopped out on that, right? Because guess what? It was 50 cents away from its stop. And so we got stopped out at 69 cents on the 6th of January, and we only kept $2 on that one. All right. So again, if it's that close, we're still saying that you should just wait a little bit, wait for it to, wait for it to move away from the stop loss and take a little bit less premium. That way you have a much higher likelihood of actually getting the premium collected and not getting stopped out. So that one was pretty close. I probably wouldn't have taken it, only 50 cents away, but if anybody did, they got stopped. They just made a tiny profit there. Okay, going to TLT. Now TLT, again, to reiterate, the only thing you kind of is highly recommended if you're going to take the trader trend or the investor trend is that you sell the unit, and they could put here at market when the market opens or after a few minutes to let spreads kind of settle down. And then you set up the bull call spread, right? So you set the bull call spread up if TLT is at 109 or below, with a stop at 105.64 and the target at 119.10. Remember, you guys, if you have a naked put and a bull call spread, you basically have you have a short put and a long call, which is a synthetic stock, and then you have the short call and the bull call spread, so you're making a covered call. So that's what we're trying to do here. Now, the way this played out, price opened at 105.83, which was very, very, very close to your stop. If you had got in, you got stopped out right away for an $11 loss. Also, because remember, we closed both the short put and the bull call spread at 105.64. So the thing opened at 105.83, right? And you're going to get stopped out pretty quick. It's only 20 cents of play there. So over here, you got into the bull call spread as well. If you had done that, you got stopped out real quick, for a very small, $9 loss here, right? So if you had got in, you only would have lost $20. But again, we would recommend giving space as opposed to and waiting a little bit as opposed to actually trying to take that trade and getting a high likelihood of a stop out. So going down to LQD, it was to sell the 109 naked put, and then enter the bull call spread if LQD was at 109.48 or below, with a stop at 107.37. Now price opened here, right, at 108.43. So at 108.43, you still had a little bit of room, right, to 107.37. But it was the actual, it was underneath 109.48. So you might have wanted to take this one, or wait until it breaks back through to take that 109.48. Let's say LQD prints 109.50, then you could sell the put, or I'm sorry, you could buy the bull call spread and do that against your naked put. And so if you had done that, you would have got filled at 152 when price opened. It did stop us out for a $98 stop, so it went and dropped down to the stop itself. The bull call spread obviously got filled as well, and that got stopped for $60. Okay, so going to EFA. EFA, we had sell the Jan 65.50 naked put. Then the conditional bull put spread. Now, again, remember, if we do the bull put spread, it's mechanically the same and mathematically the same as the bull call spread. We just do it because, um, we have what the heck's it called? Not the derivative, but oh man, this word's escaping me. But, geez, what's it called? My brain is fried today, you guys. But anyway, there's a good reason for it. But don't worry about doing it. It basically just it protects you going forward on these things. Okay, so it'll come back to me. Trust me. So with DFA, you got filled at 127 if you had taken this. Stops were below 47.85. It opened at 65.63. And so, with this one, well, I'm sorry, I'm on the wrong thing. Yeah, there we go. It opened at 65.63. Stops were at 63.63. So if you had got in, you had $2 worth of stop. You got in, you took the whole premium, right? So it actually never got stopped out. The bull call spread, which again, or the bull put spread again, this is the big aggressive one. You don't have to do this unless you're really aggressive on this thing. But if you did do it, then you got filled, and you made another $127 on this as well. Okay, so this one, that one actually played out. And EWW, no entry, open above stop. So again, EWW, you were gonna sell this 49.78 naked call with a stop at 49.70, and it opened at 49.90. So guess what? We're not gonna sell that because we're over the stop loss. So nothing there. EWZ, we're selling the 30.50 naked call with a stop at 30.47. That one price opened at 26.39. So you would have sold that and got 17 cents. It never got near its stop, so you made 17 bucks. Okay. So going to gold. Gold, we were selling the 165 naked put, the January units, and then we were going to conditionally see if we were below 165 to do the bull call spread with a target of 172.75 and a stop at 162.47. Now, it opened and at 166.71, and you got the 167 credit for it. It never got stopped out, and so you took the entire thing for credit. Or good practice is to give me 1 second, you guys. Hold on, I gotta pause this. Dog, we're trying to go to my neighbor's house. So, anyways, going back to gold. So you took the entire credit here, and then you did not get filled on the bull call spread. So price never dropped below 165.04. Silver, the recommendation was to sell the Jan 20 naked put, and to get in the conditional entry on the bull call spread if it price dropped below 2012. Now, price opened at 21.35. We got a 23-cent credit for it. Never got filled on the vert. All right, so you made 23 cents. Now again, I was going back to gold real quick. With the price here, remember, good practice, best practice is to bid those units back for a nickel. With smaller, stocks like silver, like a $20 stock, bid it back for maybe I bid it back for like 2 cents. Because it's pretty much 5 cents. If you're taking that off of 23, you're taking off a big chunk of your profits, and chances are it's going to get down to 2 cents. So that's just my recommendation. The 912, kind of has their own rules in the 5 cent one, and you can kind of refer back to those. But I'm just telling you kind of what I do as far as bidding back my short units. So going to XME, the recommendation over here was to sell the Jan 51 naked put, and to do the bull call spread, 51.6 bull call spread if price drops 51.23 with a target of 56.36 and a stop at 49.53. So price opened at 50.09, and you got filled on that for 262. Now again, you were really, really close, right, to getting stopped out, which is exactly what happened. So there's another one, give it a little bit of breathing room, all right? But just mathematically, you got stopped on that. You got filled on the bull call spread as well and got stopped on that as well, okay? So we kind of keep seeing it happen over and over again. We try to take these things too tight. Now, they might work here and there with really high risk to reward, but they usually are going to get knocked out. Okay, so it's just playing that way. Now, you could try them because there's small losses if you get hit, but in general, give it a little bit of space. It's going to most likely increase your likelihood of getting these short units back. Okay, so going to XLE. All right, so we got XLE here. I'm sorry, I skipped XOP. So XOP was to sell the 142 naked call with a stop at 140, 149. XOP opened at 135.11. And if you sold that call, you got 365 for it. Then we did get stopped on the 17th of January, but you had credit from Theta Decay, so you made 195 on that. Okay. And so XLE was to sell the 87 naked put and then do a bull call spread, 87.97 bull call spread. If price drop below 87.22 with a target of 97.23 and a stop of the whole thing at 83.89. Now XLE opened at 84.38. Again, really, really close to your stop, right? You're only 40 cents. Guess what? We got stopped out. And we got stopped out of the vert too. Okay, so continuing down to DBA. DBA was just to sell the 20 naked call with a stop at 2011. Now again, on these ones too, remember guys, conservative trader maintain cash positions. You don't even have to do that. If you're conservative, just don't do the trade. Move on to the next one. All right. Again, it's for you to decide, which is why again results kind of vary on these things because it really depends on your risk tolerance and what you decide to take, what you don't decide to take. So on this one, you got filled for 30 cents. It never got stopped, so you got your entire 30-cent credit back. Going to XBI, XBI was to sell the 82 naked call if with a stop at 81.90. Now XBI opened at 82.03, so it was 15 cents above, 13 cents above the stop, so there was no entry. Going to VNQ, VNQ was to sell the Jan 88 naked call with a stop at 87.30. VNQ opened at 84. You took 60 cents in and you collected the entire premium, and it went down to get 60 bucks for it. Okay. Um, XHB, the recommendation was to sell the 62 naked put and then put on the 62, 67 bull call spread if price was 62.07 or below, with a conditional target at 67.33 and a stop at 60.32. So going over to XHB, we see that we opened at 61.14, which is, it's about 80 cents roughly away from the stop. If you had got in, you would have got a 245-cent credit. We did get stopped out on the 19th of December for $50 loss. It was a little bit less just because we had a few days go by. And then you did get filled on the bull call spread, but that also took a $20 loss, okay, because it got filled when the day got stopped out. Uh, so yeah, we got that one. Or actually, I'm sorry, we filled it right away, but it just got stopped out. Going to SPY. Again, SPY, you were either going to sell the Jan 392 naked call with a stop at 391.77 or maintain cash position. If you had taken that, we opened at 383.47. You took a $6 credit here, 603 credit for getting into that. It did get stopped out, but you kind of just were pretty break even. $6 is what kind of happened, or $3 is kind of what happened on that one. So price ran up into the stops, but theta, luckily, and a little bit of decay saved us from saved the units from getting totally obliterated there. So here we go. We got the Qs. Again, you're aggressive. You could have sold the 288 naked calls with a stop at 287.38 or maintain a cash position. If you had to come in and sold this, you sold it for 322. And if you did that, you got the entire thing back. Okay. It never went up and it got stopped out. IWM, the recommendation was to sell the Jan 181 naked call and with a stop at 180.75 or maintain cash position if you had sold the units. Price opened at 174.61. You would have got 247 for it, and you would have got stopped on Jan 11 for a $60 loss. Okay, and so that's the whole thing, you guys. There was the total option P&L for the whole thing was 699, so it was a profitable run if you added all that up. And it worked out. It worked out pretty well. And so again, this is really, really mechanical to put in. It doesn't take that long to do. It's just a lot of button pushing and getting it all set up the night before, and then just executing these things. Again, I usually wait a few minutes for spreads to kind of tighten up on Monday at the open because they tend to be really big if you just put them on overnight and let them open, let them go right when they. But you can do that too. So it'll still kind of play off. But there is a little bit of slippage. Everybody's broker's gonna be a little different. But this is tracking it as best I can to see how it works. So this is the review, guys. Please, again, if you have any questions or comments, go ahead and throw them in the YouTube comment section. Like, subscribe, tell people that are interested in options trading about the newsletter. You could, my links and 912's main link is going to be on the comments or in down in the comment section as usual. And again, thanks everybody, and we'll see you next time.